Hello, and welcome to today's seminar on solo success, financial wisdom for the unstoppable woman, where we'll discuss the financial planning ideas and solutions to help independent women succeed in their financial lives. I'm Lisette Smith, and I'm a senior advisor here at the advisory group, and I work with our personal wealth clients.
And I'm Margaret Hiller, and I'm a senior advisor to our personal wealth and institutional clients. Today, we are going to be discussing the evolution of women's needs in financial planning, and in particular, the needs of women who are on their own. So this may include women with or without children who are never married or divorced or widowed. We will examine some of the changes in demographics that we've seen in the last several decades that have led to more women taking care of themselves financially. We will consider the quantitative and qualitative benefits of a solo lifestyle. And we will also talk about the various areas of financial planning and specific differences for women who are planning independently versus as part of a couple.
So if you're living your life independently already, you should know that though you may be solo, you're really not alone. The percentage of people living without a partner has grown considerably in the past few decades. So since 1990, this research from the Pew Research Center shows that the number of US adults aged 25 to 54 living without a spouse or partner has risen from 29% in 1990 to 38% today. And more women are on their own, whether by choice or circumstance. We see this in our own practice, giving more help to solo women and their independent financial plans. We're going to focus a lot today on people who are already solo, but much of this information is for women who may currently be married, but may divorce or become widowed in the future. Women live an average of 5 years longer than men. So the longevity numbers tell us that it's likely that women will be single at some point. The greater independence by women is often attributed to increased opportunities over the last few decades, including career and independence in home ownership. Women no longer need to marry for financial security as they may have had to in the past. In fact, home ownership by single women is much higher than it is for single men. 58% of single women versus 42% of single men are homeowners. Some of this is attributable to women over 65 who are likely widowed, but still the number of independent women buying their own homes has been rising. And the good news is that, or additional good news is that as trends change, the benefits of a single lifestyle are more widely recognized, including the discretion that solo women specifically have over how they spend their time and their money.
So, as Lisette just mentioned, there are many benefits to living solo. First and foremost is that you are only responsible for yourself. You are in full control of how you choose to live, how much you want to save versus how much you want to spend. Decision making is very easy. You get to decide. You don't have any need for any negotiation or any compromise. You get to decide everything from what TV show you would like to watch to what you'd like to have for dinner, where you'd like to go on vacation, etc. You can be more mobile and flexible. So for example, if you live in California and a job opportunity comes up in Chicago, you can decide whether you want to move there and take it. You don't have to worry about taking into consideration a partner's job. Um, One significant benefit is that there's often more ability to keep your financial life simpler when you only have to worry about yourself. You may have fewer bank accounts and investment accounts, and it may be easier for you to see the big picture of what you have, what you earn, what you spend, and what you need to work towards.
And while it's true that there are a lot of benefits of being single, according to a TD Ameritrade study, when it comes to financial security, only 29% of single adults feel financially secure compared to 43% for married people. And this is something clearly we would like to change by ensuring that single people have the planning necessary to have confidence in their financial lives. The freedom that comes from being single also means more of a need to have a solid financial foundation, because living independently may cost more than you would expect. Although you may think two individual people could live on half as much as a couple, but the math just doesn't work that way. There's a premium for living independently, as many of you know. The cost for individual living is about 65% of the cost of uh, two individuals living together, so not half that amount. Much of that is attributable to housing, but even travel, certainly health insurance, even grocery costs because of serving sizes and waste can be higher for single people. And for these reasons, the solo woman has to have a stronger foundation. And the kind of first important item here is the same in all financial planning, which is thinking about cash reserves and emergency funds, since you don't get to share that risk with two working spouses. The general recommendation is usually 3 to 6 months for cash reserves, but single people really should be on the higher end of that and maybe even having closer to a year of available reserves. Um, Really, every woman, but more so the independent woman, needs to advocate for herself in terms of her career to ensure that she's compensated at a level commensurate with her male counterparts. Any additional income that is negotiating really helps bolster the long-term financial plan in every area. And even though it's an area where women have made some strides in recent years, it's a really critical one. There was an interesting study in the Harvard Business School, and it was in 2015, so maybe things have changed since then, but more than 100 managers were asked to allocate a fixed pool of money for raises among professionally skilled employees. And when they were told that the employees couldn't negotiate, they gave the males and females equal raises. But when they were told that they might have to explain the raise to the workers, they gave raises nearly 2.5 times larger to the men, because they just didn't expect that the woman would ask questions or negotiate even if they could. We really could spend a whole session on the importance of income equality to women's financial health, and maybe we will, but it's really an important element to long-term financial success overall. The more you earn, the more you can save and spend. Um, there are special circumstances really in all areas of financial planning that we take into account when planning for single clients. So we will review those in more detail.
When we work with clients on their financial plans, there are 5 primary areas that we focus on. So first we have financial independence, which includes building wealth over the years to fund the retirement. A corollary to that is tax planning, where we look for ways to be strategic about tax liability over the years. So this may include discussions around Roth conversions, asset location, in different types of accounts, bunching of tax deductions, and more. In estate planning, so this includes planning, not only planning for the disposition of your estate at the time of your death, but it also includes direction for how you wish to have things handled during your lifetime in the event that you are unable to make those decisions for yourself. Risk management focuses on protecting yourself against various types of risk, with the prudent use of insurance. Then we have specialized planning, which includes any other areas that are unique to your situation. So that might include college planning, charitable giving, real estate as part of your portfolio, or making arrangements for special needs dependents. And so with all those different areas of planning, what we find is that in just about every one of them, there are reasons that it may be appropriate to approach them differently if we're working with a solo woman versus a couple.
So first, when we talk about financial independence, we're meaning not just retirement, but the ability to have options to change careers or take time off, or maybe take on less lucrative job opportunities. So we advise people to save as aggressively as possible for retirement at an early age. Even if you think you may have a partner in the future, you may also have a period of lower earnings. And it's just good to have a good base for investment compounding. You'll have more time to grow your assets and more flexibility if you want or need to take time off for some reason. Many women face the risk of not reaching their full retirement age because they have to retire early to take care of family members. And this can mean not only less time to save, but added pressure on your savings to last longer than expected. If you, some good news, if you happen to have a pension plan, which is becoming fairly rare, but one benefit is that if you can choose a single annuity for your pension, if you're single, which maximizes the payments to you in retirement, whereas most married people would choose joint and survivor, which would be less payments early on because it also covers a partner. And since being solo can help you be more flexible in your career, we do calculations around, we take into account the lack of Social Security contributions during time that you might earn less or take time off so that we can get an accurate view of what you'll receive later. It's always a good idea to look at your Social Security credits annually to get an idea of what's available to you in the future. For people that have been divorced, there are specific Social Security implications. If you were married more than 10 years, you can get benefits based on your ex-spouse's benefits. Even if they died, you can get benefits the same as a surviving spouse, as long as your marriage lasted 10 years or more. If you remarry, that would terminate the benefits based on an ex-spouse, but not if you marry over age 60. So there's some specifics that we could look at depending on your situation. And your marital status doesn't affect your eligibility for Medicare, but you may need to pay for part of it if you didn't pay in for at least 10 years. So in the case of a divorced couple, if you were married at least 10 years, you can still use your former spouse's record to avoid paying those premiums. And finally, we talk a lot about aligning your portfolio to invest for the long term, which again is not so specific to single people, but it's important because you have more flexibility in how you plan, and you may have a less traditional career or choose to take time off and travel or reassess. And so these things are easier to accomplish if you're independent and you've planned well. As we said in an earlier webinar, women have proven to be better investors than men. Fidelity Women in Investing study had the excess return by women investors at about a half of 1%, which doesn't seem like a lot, but over time and compounding, it can really add up. So once you gain confidence about investing, women have a more successful investment experience when they stick with their plan. And this is going to be a clear indicator of future financial success.
There's a lot to think about with regard to estate planning. So first, one very important consideration is who you want to name as the successor trustee of your living trust and the executor of your estate. And as you probably know, this can be a very big responsibility to appoint someone to handle. If you have adult children, one of them may be the person that you choose to designate. But what if your children are not able to do so for one reason or another, or if you don't have children? You may look to siblings or nieces or nephews or other family members, or perhaps you may find that you need to explore the idea of utilizing a professional trustee for this service. Another question to consider is who you wish to appoint as your power of attorney. So it's common to appoint someone to make legal and financial decisions on your behalf in the event that you are unable to do so. It's also common to appoint someone to make medical decisions on your behalf. And these may or may not be the same person. Another thing that we find when working with a solo woman is that it becomes more important to have a letter of instruction stating your wishes. So this document has no legal authority, but it's an important way to convey your wishes about how things are handled after you pass away. This letter can include anything from something like, I wish to be cremated, to who you would like to receive your grandmother's heirloom wedding ring that you possess. It also may include things to be helpful, such as a list of all of your accounts or where you have your safe deposit box or who your CPA and estate attorney are. Perhaps it even includes something like the password to your email account or the code to access your cell phone. This letter helps to serves to help the person who's going to be handling your estate after you pass away. Part of your estate plan includes an advanced healthcare directive, which is where you give instructions about your preferences for medical treatment. And so it's very important to have all of these documents prepared in advance and provided to your physicians so that they're in your file in case they're ever needed. When you establish bank and brokerage accounts, you will want to give careful consideration to how you title the accounts. You'll either want to be sure that they are structured, that they're set up either in a living trust or with a transfer on death designation. You want to be sure that they're structured to pass to your designated beneficiaries without going through probate. And both of those methods accomplish that. So whether you title it as a living trust or you include this transfer on death designation, then the assets will transfer to the beneficiaries without going through probate. It's more important than ever that you name beneficiaries on all of your retirement accounts if you're a solo woman. If you fail to do so, your employer-sponsored plan balances will pass in accordance with the terms of the plan document. And the plan document has a specific order, which may or may not be at all what you intend to have happen with your retirement money. As you plan for yourself, you'll have to be more mindful of estate tax limits. So currently those limits are very high. They're close to $13 million per person this year, but they are due to sunset at the end of 2025. And it remains to be seen what the limits will be after that date. It's possible that they will be lower in future years. So depending on where the limits fall relative to the size of your estate, it may be more important to consider strategies to reduce your estate. So whether that's going to be gifting or charitable donations or other more complex strategies. And then last but not least, you may be wondering why we have a picture of a French bulldog on this page. It's important to plan for your pets. So you may remember the famous story many years ago of Leona Helmsley, who left millions of dollars to her in her estate to her dog. And we are certainly not advising that, but it's a good idea to think about who you would want to take care of your pet if something happens to you. This is another example of something that you might want to include in your letter of instruction.
Yeah, that is a good picture of the, the bulldog. Um, in terms of tax planning, when there's kind of pros and cons to being single when it comes to tax planning. Generally, a single person's tax return can be less complex than that of a married couple, which is a benefit. And there isn't the associated impact of another person's income and deductions to blend and plan together. It can also be advantageous in terms of some of the deductions that have income level restrictions. And the most common one of these is medical deductions, where you have to have a certain percentage of your income they have to be over a certain percentage of your income in order to have that deduction. So it may be easier to attain that with a lower income overall. But on the con side, there's not the opportunity to aggregate income with others, which, depending on the circumstances, can lower your overall effective tax rate based on married filing jointly tax tables. Single filers also don't receive some tax incentives that are reserved for married people with non-working spouses, like a spousal IRA. Unfortunately, the federal tax system, I would say, is still geared to incentivize marriage, and specifically marriages with a non-working spouse. However, if you're single with custody of children, you can qualify as a head of household status for your tax preparation, and that's generally the most advantageous of the filing statuses.
When we talk about risk management, we're usually talking about everything from property and casualty insurance to umbrella liability insurance to disability, life insurance, and long-term care insurance. As a solo woman, you may have need for more life insurance if you have dependent children, or little or no life insurance if you have nobody who's financially dependent upon you. However, a solo woman who's still in her earning years will likely want to have disability insurance. Just imagine if you had some kind of medical issue that meant that you were unable to work for an extended period of time. Good disability coverage could be very helpful to you so that you can maintain your standard of living for that period with no income. A solo woman also may have a need for umbrella liability insurance. For example, perhaps to protect against a claim if someone is ever injured on your property, or if you have a teenage driver who causes damage that's in excess of your auto policy limits. This is one of those types of insurance that's relatively inexpensive to obtain because it's low probability, but it is very high magnitude potential when those things arise. So in the unlikely event that you find yourself in that situation, it's a very beneficial type of coverage to have to protect your assets. A solo woman will also want to consider whether long-term care insurance is needed to help with the cost of care in the later years. A woman with substantial assets may choose simply to self-insure for that risk, but many people have exposure in that area because the cost of care late in life can be very expensive. So this is a bigger risk for a person who is living independently.
The next element of financial planning that we want to talk about is charitable giving. As we mentioned earlier, many people who are on their own are more involved in their communities and volunteer activities, and especially among singles who are child-free, having a plan that focuses on dying with zero or coming as close as possible to using all of your assets during your lifetime is a popular option or a popular planning strategy. So even though saving for retirement can be challenging on your own in some ways, the fact that you don't have to plan for others after your death can provide some freedom in spending during your lifetime to help causes you care about, both during your life and as part of your legacy. There was a 2018 Pew Research study that showed that single women, whether divorced, widowed, or never married, were more likely than single men to give to charity. Single women also, on average, give higher dollar amounts than single men. And even though overall, um, with both single and married people, men donated more, much of that was to political causes, while women give to community causes more frequently. So this trend has really caught the attention of, excuse me, many charitable organizations who have become more focused on women, and single women in particular who are connected to their causes. So as women's incomes rise, it makes sense to come up with a charitable giving plan during your lifetime to make meaningful contributions to the causes close to you. Of course, you can just donate directly, but if your income is high now, but may not be as high in the future, it sometimes makes sense to create a donor advised fund, which is offered through financial institutions like Schwab and Fidelity and others, which allows you to donate to and take a charitable deduction now, and then you can make the contributions to the charities of your choice over time. There is a requirement that these be to bona fide 501c3 organizations, but it can include very small local charities. It just doesn't include lobbying or political campaigns. In addition to that kind of direct giving, um, you can, there should be, you should be aware of some approaches that can help you to provide income to you during your retirement, but ultimately go to charity. And one of the most common of these is a charitable remainder trust, which allows you to get a current income tax deduction for a share of the fund you set up, then take income over your lifetime, and then give the balance to charity. And this is, again, especially appropriate for those who are child free and want their assets eventually to go to charity anyway. So you can set this up and even change the designated charity along the way by amending the trust. And a charitable gift annuity is similar, except you give to the charity now and you get an annuity back over your lifetime, and the remainder goes to the charity when you die. There are also some current income tax benefits of making this. So it's good to do this kind of before you retire, as part of your plan before you retire. So there's really several options, and we could go into more detail, that should be explored as part of a long-term planning for single people, and both part of current retirement planning and your legacy strategy.
It's widely known that women on the whole outlive men. And this means that as a society, we have more women who are living alone in their later years. In some cases, they are widows or perhaps divorcees. And in other cases, they were never married. You may remember the show The Golden Girls with the late Betty White. This was a story about senior women who were living together. There's some significant benefits to cohabitating later in life, notwithstanding some of the sparring that they may have displayed on the show. Not only can it save you money on your living expenses, but you can help take care of each other and perhaps even hire or share the hiring of caregivers in your home. If you have no immediate family, the concept of, quote, the family that you choose becomes even more important. So just like the idea of Friendsgiving, where you spend Thanksgiving with your treasured friends rather than your blood relatives, as you age independently, it becomes more important that you have close friends as the family that you choose. These may be the people who will call to check on you or come with you to a doctor's appointment or run to the pharmacy for you. There's a relatively new industry, new within about the last 20 years or so, called the end of life doula or the death doula. This death doula assists in a dying process, assists a dying person through the process from beginning to end. This is not the same as hospice, but it's really a complementary service. A death doula could be especially helpful to a solo woman as she nears the end of her life. This person can serve as your advocate and can help to ensure that your wishes are carried out. Nowadays, with the medical industry becoming more and more transactional and less personal than it once was, a death doula can be especially beneficial.
Um, that is a difficult segue to divorce considerations, but we did want to touch on some things. Some of these are things that you really need to consider before divorcing, but if you are single due to divorce or considering divorce, there are few special circumstances that you should consider to ensure that you come out as strong as possible financially. We already mentioned Social Security rules around divorce and the ability to claim your ex's benefit if you were married for more than 10 years or 10 years or more. Another common issue around divorce and retirement has to do with the splitting of retirement funds. If, like many in a divorce, you received part of your ex-spouse's retirement through a qualified domestic relations order or a quadro, it's important to preserve the penalty-free withdrawal option. A quadro allows the withdrawal of money from a one-time withdrawal of money from a qualified retirement account free from what is typically a 10% early withdrawal penalty. If this opportunity is limited to a spousal withdrawal, and even though generally the qualified retirement account beneficiary would have to wait until the age 59 and a half to withdraw, you can get a one-time payout before you roll over the proceeds into your IRA. It would still be subject to tax. So when you do the one-time payout, assuming you need those funds now, it's smart to have the amount you withdraw include the amount needed for tax in the same withdrawal because you only get one. Also, be sure as part of your divorce to dispense with joint debt as soon as possible if this was not part of the final divorce. And sometimes it isn't for a variety of reasons, including that currently people who have very good mortgage rates from previous financing, they don't want to lose by refinancing individually. But intertwining this debt can be risky over the long term. So try to take care of that as soon as you can. It's important too that if you hadn't done so while you were married, and many women still don't, you need to establish credit in your own name and build up your own credit history. Keep track of your credit score to ensure that there are no mistakes on it and ensure that you have a strong credit score that allows you to borrow at favorable rates. This can make a big difference in your overall financial health. It's generally on the top of everyone's list, but it's important to update your beneficiaries on your insurance and retirement plans when you divorce, since those assets transfer based on those designations, not through your will, as Margaret mentioned earlier.
We wanted also to call out a few important notes for widows. So if you are a surviving spouse of someone who has paid in enough into Social Security over the years, you can claim a reduced monthly benefit for yourself as early as age 60. That's the reduced rate, or you could postpone to draw at the full rate. If you yourself have also paid into Social Security, you can then switch to your benefit as early as age 62. So it's worthwhile to evaluate the various claiming strategies for your situation to maximize your benefit. And I will say claiming strategies with Social Security is a whole world unto itself. There are hundreds of different permutations in terms of claiming strategies. So a lot to think about, particularly for a widow and a widow who's been earning and paying in for herself. There is also an important note for a widow who inherits her spouse's retirement benefits out of an employer-sponsored plan. So this is similar to what Lisette just mentioned with regard to divorce division of assets with a company-sponsored retirement plan. As you are probably well aware, one must generally be over age 59 and a half to draw upon a tax-deferred retirement plan out of an employer-sponsored account without paying a 10% penalty for early withdrawal. So normally you have to be over age 59 and a half. There is an exception to this penalty if you are receiving it as a death benefit. So for example, if your husband passes away and leaves his 401k to you. However, if you yourself are under age 59 and a half at that time, you need to be very careful that you preserve the exception to this penalty. It's only available to you if you withdraw your benefit directly from the 401k plan, meaning that you don't first roll it into your own IRA, or if you transfer it into an inherited IRA. As soon as you transfer that balance into your own IRA, for example, combine it with your own existing IRA balances, you lose that exception to the penalty-free withdrawal. So of course, if you're over age 59 and a half yourself, then this is not an issue. But it's a very important reminder for those who are under 59 and a half and who are entitled to a death benefit in a retirement account.
So we've touched on a lot of points here today, and most have much, much more detail that could be explored. We wanted to just really give you an overview of some of these important issues. In some ways, for us, doing financial planning for individuals is especially rewarding. We can help chart the path for those on their own, and we can kind of be more creative, and it's a more personal experience in many ways, where in the past there may have been some stigma in navigating life independently. As numbers grow and more research is directed at the lives of single people, there's much more evidence that singles enjoy overall happiness, at least on par with those in couples. A Michigan State University study over 40 years showed an almost equal level of self-reported happiness among long married couples compared to those who are single or divorced. And similar studies recently reinforce that equality of satisfaction and fulfillment between people who are single and those who are partnered. Even though there are challenges to living in any situation, but living well and enjoying financial freedom is in some ways more achievable as a single person. So if you have any questions, we would be happy to go into any of these items in more detail. Every situation is unique, and we want to find out individually how we might be able to help. So we encourage you to please be in touch if you want assistance or if someone you know might benefit. If you have any questions, I don't know that we have any questions in the chat, but please reach out to us individually if you want to connect. We really appreciate your time and look forward to talking to you next time.